stand by your pen. Alright, I'll guide you first on the principle of making good decision in insurance. Okay? 3 steps. What's the first step? Number 1. You want to learn how to choose the right type of insurance. There are different types of insurance. They are all designed for different purpose. If you choose the wrong type, then you are wasting money. Okay? Once you determine the right type, you want to choose the right amount of insurance. Okay, now very simply put, insurance is for rainy days, man. It's not for wealth creation. Okay, it's one of the worst tools for wealth creation. Okay, now imagine this: you want to buy umbrella for rainy days. Okay, Singapore rain quite often. Now imagine you buy too much insurance. You know the umbrella outside the coffee bean, the Starbucks one, the big one, right? Imagine you buy an umbrella so big, you know, yeah, you take a big umbrella, before the thing can help you, right? You know, it choke you to death already. It's so heavy, it's such a burden, such a painful experience. Right? Have you seen friends around you who have been choked by insurance premium? Everyone pay for a lot of insurance, but they don't know what to pay for. Now, buying too much insurance. Now, too little insurance also got issue, no? You all drink cocktail, no? Yeah. Your cocktail there's a little umbrella. You buy the small umbrella, rain also you wet. Then what's the point? Right? Insurance you still get wet, then what's the point? Or maybe you buy an umbrella that's whole. Maybe in China maybe. Right? Oh really? I know really an umbrella you open up, it's a lot of holes, you still get wet. Alright? What is holes in insurance? It could be loading, exclusion, terms and conditions not in your favor. Make sense? Yeah, but do you know? You won't know. Unless you question the advisor, and provided the advisor is professional enough to answer you. Is it okay? Yeah. So the key is to buy the right type, right amount. Then once you get the right type, right amount, what do you do? Oh, you look big. Shock. You all cook now? Yes. You all bought fish before? Yes. Your mom, you follow your mom to the market last time, or maybe now. Now you see nothing to choose. But you go to the market, right? How do you choose a fish? First of all, what you do? You check the eye, right? Am I right? Yes. See bright or not bright? Okay, bright, right? Does it mean guaranteed fresh? No. Not yet. What do you do? Yes. You open the gill, see whether it's freshly red or not, right? Yes. But nowadays, you know, they can put strings out on chicken now, on fish out, or anything, no. Even human, right? Vaccination. Okay. So, how do you know they need to die? Correct. Just to be sure. Step 3, what you do? You press, exactly, you see, you cook obviously. You touch and see whether the fish went to the gym or not. Right? Okay, if it's foam, wow, guaranteed, fresh. This is called selection process. Don't do that. But understand now, you see, in everything, right, success is a result of process. When you have a good process of making good decision, you only naturally end up with a good outcome. So what we are doing, why are you spending cost to attend courses here and there, is to learn and develop your own process, thinking process. The better your process, the better your decision. The better your decision, the better your outcome. Is it making sense? Alright, so the fish, you got a 3-step approach, right? Okay, ideal muscle, provided no steroid, okay? Yeah, after that what you do? You bargain! You make sure you find the best deal. Am I right? So after you get the right type, right amount, get the right value. Is that making sense? Okay, how does it go? Very simply. Today I got no time today. What I'd like you to do is I'd like to invite you to draw this bell curve with me. Come, let's draw this together. You are free to use this. This is co-founded by me and my partner about 10 years ago. Feel free to use it to educate more people. Is that alright? Very simple. This, if you do it correctly, you will learn how to keep your insurance costs lean and mean. Okay, but before I continue, now, hang on. Can I have your agreement that you don't have to agree with everything I say? Is it fair? Yes. You don't have to agree with everything I say, can or not? But can also request from everyone, don't discount anything I say first. Keep an open mind. You make your own conclusion right at the end. Is it okay? Yeah? Now, there are different ways to plan for your insurance. I'm approaching it from an investor perspective, not salesman perspective. From a what perspective? Investor perspective. Now, I'm talking to you because you are investors. Am I right?
Yes.
Oh, you're investors, right? Okay, well, you're learning to be good investors, okay? So, to me, this makes perfect sense to investor. Okay, let's run through this together. Ready? Go. Now, in my view, if a person is single, and has no dependent, he don't really need life insurance. Single, no dependent, don't even have a pet goldfish, understand? Die lah. No one dependent on him, understand or not? No parents, single, no dependent. You don't need no pure life insurance, correct? Okay. Now, however, like my case, if you have elderly parents who are dependent on you, or you got married, you have a spouse dependent on you, you have your kids, you buy a car, you take car loan, you buy a house, you take house loan, you do business, you sign personal guarantee. Understand? As your liability and responsibility goes up, what happens to your insurance needs? Go up or come down? They go up, exactly. The question is, does it stay up forever? No, bingo, why? Usually, you will peak around 40s to 50s. Right? Some of us are in this thing called sandwich generation, understand? Or hamburger. You have a piece of ham, understand? You pay up there, you pay down. Alright? So usually peak around there. But what happens is, based on nature of life, one day our parents will pass on. Right? One day, our children will grow up. Hopefully. So you're 30 years to stay at home taking money from parents, no? I still study masters, I studied another masters. But don't come to the world, no? Yeah, I think I have masters in studying, you know. Hey, why more such people, no? Sorry, I can't take it, no, you know. Okay, you know the hard way. Okay, so hopefully when they are independent, right, they don't need you anymore, am I right? They are not financially dependent on you. By then, do you still need that much life insurance? Think. Will you still need that much life insurance?
No. Medical insurance.
Yeah, talk about pure life first. Pure life insurance, huh? So my friends, let me give you some insight here. Do you remember how you first bought your first policy? No. You receive a phone call, right, from a friend that haven't kept in touch for a while, am I right? No? Usually when you receive a phone call from a friend that haven't kept in touch for a while, is either getting married, borrow money, even what? Insurance, am I right? No? Yeah? Okay. So you receive a phone call. The phone call will go like this, right? Hey, how's things? How are you? Long time no see. Let's catch up for coffee. Am I right? No? The coffee is expensive. No? I don't know. So you meet up, nothing wrong. Alright? And then you see the need. Alright? You trust this person and you trust the company he represents. If it makes sense to you, you have a budget, 200, 150, 300, 400, whatever. You look at the document, you ask some question, you sign. Am I right? You got your first policy. Okay, here's your first policy. Okay. After that, another about 2-3 years, right? You receive another phone call from the same guy, am I right? No? The phone call will go like this. Hey, how are you? How's things? Hey, you know what? It's been 2 years now. It's time for what? Time for what? Review. Not served by the same guy. Time for review, am I right now, my friends? Review, buy more or buy less? Buy more. After another 2-3 years, it's time for what? Review again, buy more, buy less? Buy more, buy. My friends, let me give you the first insight in my session. A lot of Singaporeans always compare money not enough. You know where your money is? Your money is stuck in the insurance that you pay for that you don't need. Outside is bell curve. You mean because you receive some insight, right? Is it making sense to you? Don't anyhow buy. And you should go and keep also. Buy anyhow. Yeah, buy anyhow, buy the right one, yes. Understand? So my friends, if you want to keep your insurance costs lean and mean, make sure your insurance can adjust according to your insurance needs bell curve. Logical? Yes. So now, and don't you agree with me as well? Alright, eventually, you are all investors, eventually, if you do it properly, you should be financially free one day. And don't you agree, the more wealth you have, the less dependent you'll be on insurance. I'm not saying you don't use it, no. Robert Kiyosaki also use insurance, but you're less dependent on it. Warren Buffett don't need insurance, he buy insurance company. Understand? It's a whole new level together. To him, it's like, oh, medical bill, how much? $1 million? 1%? Settle. Am I right? No. for the super rich, no, it's for the not so rich, understand? Yeah. Or, you know, in general, you can agree with me, no? Yes, right? So how do you keep your insurance cost lean and mean? Okay, my friend, write this down. Write this down. The first thing you need is, just now somebody said correctly, you need to have a lifetime hospital and surgical plan. This one no negotiable one. Singapore can use CPF some more. Very good. Very safe. Okay? There are currently 5 insurance companies in Singapore. All of them in general not bad. Okay? So do I have to change the one can keep? Alright? The second thing you need to have a lifetime is lifetime critical illness plan. Why? Come on, my friends. If machine parts can fall apart, what more our human parts made of flesh and blood? It rhymes. What rhymes out of that can be a poet. Am I right now? So, whether you are young or old, rich or poor, machine part will spoil. So, this is what we will need. Either use your own money or insurance company money. You prefer use your own money or insurance company money? Yes. Insurance company money, yes, provided cost effective. There are certain scenarios whereby it's cheaper to protect yourself with your own cash. Because it's self-insured. Is it okay? Yeah, under some scenario. Okay? Now, all of you are property investor or property investor to be, right? Okay? Now, we say lifetime, okay, is it freehold or leasehold? Lifetime, freehold or leasehold?
Leasehold.
No lah. Okay, on earth is leasehold lah, but generally freehold lah. Okay? Guys, gentlemen, right? Your wife is freehold, understand? Your children is leasehold. You can only hold the hand of the children until 20 years old. Then don't hold your hand anymore. Your wife freehold, understand? Her hand is free for you to hold. You don't hold her hand, people hold. Okay, understand?
No, make sure it's freehold.
Which you will burn the hole, understand? Okay, freehold more expensive or leasehold more expensive? Oh, bingo. So this kind of permanent, this is called permanent solution. Permanent solution in general, because it's lifetime, it costs you a bit more. So you want to buy enough, but don't buy too much. Okay, just buy enough to cover a good base. That's it. Now, how about the remaining? To give you a booster for this limited period, there's a much cheaper solution. It's temporary solution. What's another name for temporary solution? Term insurance. Term insurance. For very little money, you can get very high coverage. No cash value. You want cash value for what? At 2%, 3% return, you must have put money in property, am I right or not? Or good quality stocks. Hey, my friends, between insurance and property, which one give better returns?
Property.
Property, right? Between insurance and good basket of stocks, which one overall give better returns? Stocks, exactly. Understand? What insurance company do is they take your money, they invest themselves. They give you some, they make a difference. Is that making sense to you? Right? So you want to invest wholesale, don't invest retail. Invest wholesale means invest yourself. Invest retail means you invest through someone else. Is it okay? Yeah. So now term insurance. Now, the good news is that term insurance prices have dropped so much in the last 5 years. It's so affordable today. That's the good news. Okay? Now, another thing is, okay, let's conclude this portion. You understand the bell curve now? Alright? The key thing is use permanent solution for permanent needs. Use temporary solution for your temporary needs. Till usually what? Age what? 60, 65, plus minus. Or you need them only till you're financially free. When you're financially free, you don't need term insurance. Is it okay? Unless you want to use it for legacy purpose. Which I did. Any questions so far?
Yes.
Yes, sir.
So the question regarding what do you mean by freehold and leasehold for critical illness? Yeah, talk about the term of freehold.
No, talk about lifetime. Lifetime means freehold or leasehold. I just use it as an analogy.
Oh, okay.
Basically, freehold more expensive than leasehold. So permanent solution is more expensive than temporary solution. So most of you have been buying a lot of permanent solution. Whole life, what you know what? How come salespeople seldom recommend term one? Why? I didn't say you say no, they scratch your car, don't scratch mine. Yeah.
What type of term insurance like
Well,
because I didn't buy any.
Okay, term basically, the best, okay, let me talk about this. No, since you're a property investor, let me give you some pointers. Okay, this one additional thing. Now, buy a property at, okay, in a bad market, you're going to buy property under value. In a growth environment, you very hard to buy under value. You buy car value still okay because it will rise now. Is it okay? Now, normally when you buy property, do you take loan?
Yes.
Does it make sense to take loan?
Yes.
When interest rate is cheap, it makes sense to take loan, am I right? Leverage one, then your returns can be way more. Now, so this one take note. For property loan, property, we call it mortgage insurance, right? Okay. How it works very simply. Now, if there's no interest, your loan will normally drop, right? If there's no interest, it should drop straight. But with interest, you